March 10, 2000. The Nasdaq Composite Index hits 5,048 points. It has risen 400% in 5 years. 25-year-old college dropouts are worth hundreds of millions on paper. Companies with no revenue are valued in the billions. A sock puppet is the face of a company spending more on Super Bowl ads than it makes in annual sales. And everyone thinks this is normal. Here's the insane part. These companies weren't hiding their losses. They were celebrating them. Burn rate, the speed at which a company was destroying cash, became a badge of honor. The faster you burned money, the more serious you were about growth. Profitability was for old economy dinosaurs who didn't understand the new rules. What new rules? Nobody could quite explain. Something about network effects and first-mover advantage and eyeballs and the internet changing everything. But the specifics didn't matter. What mattered was getting big fast, going public, and getting rich. In 18 months, ordinary people became millionaires by clicking buttons on E-Trade. Day traders quit their jobs. Financial advisors who recommended caution were fired by clients. The phrase irrational exuberance, coined by Alan Greenspan in 1996, became a joke. There was nothing irrational about it. This was the future. This was the new economy. And then it all collapsed. By October 2002, the Nasdaq had fallen 78% from its peak. $5 trillion in market value simply evaporated. Companies worth billions went bankrupt. The sock puppet was euthanized. Thousands of startups shut down. Hundreds of thousands lost their jobs. Retirement accounts were devastated. But here's what nobody talks about. The people who got rich during the bubble saw it coming. Not the crash specifically, but the game. They understood something the average investor didn't. This wasn't about building sustainable businesses. This was about creating a story, inflating a valuation, and getting out before reality hit. The venture capitalists knew. The investment bankers knew. The early employees who sold their shares knew. They understood that musical chairs was being played, and the music wouldn't last forever. The dot-com bubble wasn't an accident. It was a wealth transfer, carefully orchestrated, from the naive to the sophisticated. From the late arrivals to the early insiders. From Main Street to Wall Street. And the truly terrifying part? We're doing it again. Different technology, same playbook, bigger numbers. The dot-com bubble had its prophets, its profiteers, and its true believers. Marc Andreessen co-created Mosaic, the first popular web browser, while at university. Then he co-founded Netscape, which went public in August 1995 at $14 and closed the first day at $58. The company had never turned a profit. It didn't matter. Netscape's IPO was the starting gun for the dot-com race. Andreessen became the poster child for the new economy. Mary Meeker, the Morgan Stanley analyst, became known as the Queen of the Net. Her internet reports were gospel on Wall Street. She championed companies like Amazon, eBay, and Priceline. But her methodology was revolutionary and dangerous. She valued companies based on metrics like page views and registered users, not boring things like revenue or profit. This gave intellectual cover to absurd valuations. Henry Blodgett was Meeker's counterpart at Merrill Lynch. In December '98, he predicted Amazon would hit $400 per share within a year. The stock hit $400 in 3 weeks. Blodgett became a star. His recommendations moved markets. Later, we'd learn that privately, he thought many stocks he recommended were garbage. But publicly, he kept cheerleading. The real architects were the venture capitalists. John Doerr at Kleiner Perkins became famous for his investments in Netscape, Amazon, and Google. His pitch was simple. The internet was the biggest wealth creation opportunity in history, and you needed to move fast or miss out. This created immense pressure to invest, to fund companies, to go public quickly. Frank Quattroni at Credit Suisse became the king of tech IPOs. His banking group took hundreds of companies public. The fees were enormous, and the banks allocated hot IPO shares to favored clients, who could flip them for instant profits. At the bottom were the retail investors. People watching CNBC, reading about teenagers becoming millionaires, feeling like they were missing out. They opened online brokerage accounts, bought stocks with names like Pets.com and Webvan, and watched their accounts soar. Until they didn't. The internet really was revolutionary. This wasn't tulip bulbs or speculation without substance. The internet genuinely changed the world. The problem wasn't the technology. It was the timeline and the valuations. The commercial internet exploded in the mid-90s. In 1995, only 16 million people worldwide used the internet. By 2000, it was 360 million. E-commerce went from almost nothing to billions in sales. Email became ubiquitous. The web was transforming everything. This created genuine opportunity. Amazon really would become one of the most valuable companies on earth. Google really would print money. The bulls weren't wrong about the internet's potential. They were just 20 years early on the valuations. Several factors combined to create perfect bubble conditions. First, the Federal Reserve kept interest rates low through most of the 90s. Alan Greenspan had conquered inflation and was focused on maintaining growth. Low rates meant cheap money, which flowed into stocks, particularly high-growth technology stocks. Second, the 90s had been incredibly prosperous. The Cold War was over. The economy was booming. Unemployment was low. There was a genuine sense that America had entered a new era of endless growth. This created overconfidence. Third, new technologies enabled the bubble. Online trading platforms like E-Trade made it easy for anyone to buy stocks. CNBC provided constant market coverage. Internet message boards let retail investors share tips and hype stocks. The infrastructure for mass speculation was in place. Fourth, accounting rules hadn't caught up. Companies could report metrics that sounded impressive but meant nothing. They could recognize revenue in creative ways. They could spend wildly and call it investment, not expense. Fifth, there was genuine fear of missing out. The people who'd bought Microsoft or Intel early had become wealthy. The internet seemed even bigger. What if this really was a once-in-a-lifetime opportunity? This created a feedback loop. Rising stock prices attracted more investors. More investors pushed prices higher. Higher prices validated the bull thesis. Media coverage intensified. Success stories multiplied. Skepticism became career suicide. The metrics used to value companies became detached from reality. In the old economy, you valued companies based on earnings and cash flow. But most dot-coms had no earnings and negative cash flow. So new metrics were invented. Revenue growth became paramount, even if every sale lost money. Customer acquisition was celebrated, even if those customers would never be profitable. Market share in undefined markets was touted. Metrics like eyeballs and page views were treated as serious business indicators. The most absurd was burn rate. How fast a company was destroying cash became a positive signal. It showed they were investing aggressively in growth. Never mind that many had no plausible path to profitability. And the story was always the same. This company was going to dominate its space. It was going to benefit from network effects and achieve winner-take-all dominance. Traditional valuation methods didn't apply because this was the new economy. The business plans were remarkably similar. Raise venture capital. Spend that capital on marketing. Raise more capital at a higher valuation. Go public. Let the public markets fund continued losses while insiders sold shares. Notice what's missing? Profitability. A sustainable business model. Any plan for how this actually works long-term? By late 1999, things had reached peak absurdity. Companies were going public with barely any history. Venture capitalists were funding companies with nothing but a pitch deck. Valuations were in the billions for businesses that would never justify them. But nobody wanted to be the one calling the top. Because maybe this time really was different. Maybe the skeptics really were old economy dinosaurs who didn't get it. They got it. They'd just be proven right a little bit later. The dot-com bubble doesn't have a clear starting date, but Netscape's IPO in August 1995 is as good as any. The company priced shares at $28. When the stock opened for trading, demand was so intense that the first trade happened 90 minutes late at $71. By day's end, Netscape closed at $58, valuing the company at almost $3 billion. This sent a signal. Internet companies could command insane valuations regardless of profits. But 1999 was when things went truly insane. In January 99, the Nasdaq was at 2,200. By March 2000, it would hit 5,000. In 14 months, the index more than doubled. Priceline.com went public in March 99 at $16 per share. The company had losses of $114 million on revenues of $35 million. By April, the stock hit 162, valuing the company at $23 billion. The founder was briefly worth $9 billion on paper. For a company that helped people buy airplane tickets, Yahoo was valued at $128 billion by January 2000. That was more than Disney, News Corp, and Viacom combined. Yahoo's revenue was about $600 million annually. Somehow, a website was worth more than the entire entertainment industry. eToys went public in May 99 at $20. It closed the first day at $76. The company was valued at almost $8 billion. Toys R Us, a profitable company with actual stores and $11 billion in revenues, was valued at $6 billion. Pets.com might be the most famous disaster. The company sold pet supplies online. Pet food is heavy and cheap. Shipping costs more than the margin. Every sale lost money. But Pets.com raised over $300 million, spent millions on a Super Bowl ad featuring their sock puppet mascot, and went public in February 2000. 9 months later, they shut down. The entire company was liquidated for about $1 million. The mania peaked in March 2000. The Nasdaq hit 5,048 on March 10th. In the previous year, it had risen 86%. Some individual stocks had risen 1,000% or more. Then, quietly, things started cracking. There wasn't a single trigger. Instead, people slowly started asking uncomfortable questions. When would these companies become profitable? What happened when they ran out of cash? Were the valuations justified? The Nasdaq peaked on March 10th and started declining. At first, it seemed like a normal correction. But the decline continued and accelerated. By April, major dot-coms were missing revenue projections. In May, several high-profile startups announced they were running out of cash. The IPO market went ice-cold. The venture capital spigot tightened. The second half of 2000 was carnage. Company after company announced layoffs, then shutdowns. Webvan, which had raised over $800 million to deliver groceries, shut down. Cosmo collapsed. Boo.com, a fashion retailer that burned through $135 million in 18 months, went bankrupt. The stocks that had soared fell even faster. Priceline fell from $162 to below $1. Yahoo dropped from over $200 to below $10. Amazon fell from over $100 to $6. By 2001, the crash was in full effect. The Nasdaq would eventually bottom in October 2002 at 114, down 78% from the peak. The wreckage was enormous. Hundreds of dot-coms went bankrupt. Billions in venture capital was lost. Telecommunications companies that had borrowed massively to build fiber optic networks collapsed. WorldCom and Global Crossing went into bankruptcy. Ordinary investors were devastated. People who'd put retirement savings into tech stocks watched them become worthless. Day traders who'd quit their jobs were wiped out. The 20-something millionaires saw their paper fortunes evaporate. The analysts who'd hyped the stocks faced consequences. Henry Blodgett was banned from the securities industry for life. Investigations revealed they'd been privately calling stocks junk while publicly recommending them. But the insiders largely escaped. The venture capitalists who'd funded the bubble had sold portions of their holdings at inflated prices. The investment bankers had collected enormous fees. The executives who'd taken companies public often sold shares before the collapse. If you think we learned our lesson, look around. We're doing it again. The technology has changed. The buzzwords are different, but the dynamics are identical. In the dot-com era, the magic words were internet and e-commerce. Today, they're artificial intelligence, blockchain, and disruption. The pitch is the same. This technology changes everything. Traditional valuation doesn't apply. Get in now or miss out. Look at the SPACs that exploded in 2020 and 21. These were blank check companies that went public with no actual business. Many have collapsed or are trading below their IPO price. The cryptocurrency bubble saw over $2 trillion in value evaporate in 2022. FTX, once valued at $32 billion, collapsed into fraud and bankruptcy. The NFT craze was pure .com insanity. Digital images selling for millions because they were unique. When people stopped believing the story, the market collapsed. The meme stock phenomenon in 2021 showed that retail speculation is alive and well. GameStop and AMC surged not because of fundamentals but because of social media hype. Even in legitimate tech, we see bubble dynamics. Companies losing billions annually are valued in the hundreds of billions because of growth narratives. Profitability is delayed indefinitely while companies chase market share. The venture capital model hasn't changed. Fund companies, let them burn cash to grow, take them public, and let someone else worry about profitability. The emphasis is on growth at all costs. We even have the same conflicts of interest. Analysts at banks that underwrite IPOs are rating those same stocks. The incentives are to hype and inflate, not to provide honest assessment. The signs of a bubble are present. Absurd valuations disconnected from fundamentals. New metrics that justify prices. Fear of missing out driving decisions. Easy money from central banks inflating asset prices. The difference now is the scale. The dot-com bubble was mostly contained to tech stocks. Today's bubbles are everywhere. Stocks, crypto, real estate, private equity. The entire financial system is inflated by over a decade of near-zero interest rates. When this bubble pops, and it will pop, the damage will be far greater than the dot-com crash. The dot-com bubble teaches us three critical lessons we keep ignoring. First, technology and value are not the same thing. The internet really did change the world. But that didn't mean every internet company was valuable. Most were garbage wrapped in a story. Today, AI and blockchain might be transformative, but that doesn't make every AI startup or crypto token worth anything. Second, valuation matters. It always has and always will. You can't justify infinite prices with growth narratives. Eventually, companies need to make money. If the math doesn't work, the stock price will eventually reflect reality. Third, euphoria is a sell signal. When everyone agrees something is a sure thing, when skeptics are mocked, when new paradigms are announced and old rules are declared obsolete, that's when you should be most careful. The people who got wealthy during the dot-com bubble understood that markets are cyclical, that bubbles always pop, that getting out before the crowd is how you win. The people who lost everything believed the hype and held on too long. We're in another bubble right now. Different assets, same dynamics. And when it pops, most people will act surprised, will claim nobody could have seen it coming. But you can see it coming. The signs are everywhere. Absurd valuations, easy money, fear of missing out, new paradigm thinking. The question is whether you'll learn from history or repeat it. If this video made you question what you thought you knew about investing, if it changed how you see current market mania, share it. Because the more people who understand bubble dynamics, the fewer will be devastated when this one pops. Subscribe for more explorations of financial manias and the patterns that repeat throughout history. The dot-com bubble isn't ancient history. It's a preview of our future. And those who remember it might just survive what's coming next.